Hey guys, TommyBryson here, and what ETFs should you be investing into and why? And by the way, I started investing into ETFs like around 2018 with just $7. Literally $7 I started investing into ETFs with. And today I have around 180K invested into ETFs, and I select them the correct way. I keep a good balance, I invest very frequently, and I'll tell you my whole strategy and why I invest the way I invest. But it all comes down to that old saying that says basically, you don't want to put all your eggs in one basket, because guess what? If it gets stolen or if it falls down, if it cracks, you're going to lose everything you actually have. And that's why instead of buying individual eggs, individual companies, what you usually want to do is say, hey, I'm just going to go ahead and buy the entire basket. That way, that basket gets replaced with eggs all the time. If one goes bad or one cracks, doesn't matter. They get replaced, and that way, I am better off. But even then, even when you own the entire basket, these baskets are, for example, maybe the US market, the international market, the small market, the emerging market. The answer is you have to have different baskets. This way you get a piece of the entire pie. And that's what I'm going to break down in this video. By the way, comment down below, guys, and let me know what came first, the chicken or the egg. And by the way, don't just say chicken and egg. No, comment down below and give me a full-blown reason. I've heard this all the time, and I have never ever bothered to actually do my research. So just comment down below, let me know which came first, the chicken or the egg. Now, if you guys are new here, guys, I post videos every single day, so make sure to go ahead and subscribe to the channel and hit the bell so you get notified. And on top of that, also destroy the like button, because it does help a lot with the channel and the algorithm and all of that fancy stuff. Now, the very first thing is this. Tommy, what exactly is an ETF, and how exactly does it work, and how exactly does the price of an ETF basically come into fruition? Now, it's very simple, guys. An ETF is basically an exchange traded fund. So in a way, it's kind of like an index fund, but instead of being traded, for example, just within the mutual fund, is actually traded on the stock market exchange. So it means basically, although the ETF is based on the net asset value, it can also be influenced by basically people trying to buy a lot more of it and demand, supply, and all of that fancy stuff. So again, it's just kind of like an index fund that's traded on the stock market. That's the whole concept in a way of an ETF. And that's why you have, for example, index funds, but you also have ETFs that are tracking the same thing that those index funds are actually tracking. And in a lot of ways, that's actually cheaper, because usually you can buy an ETF with maybe $5 or $10 or $20, and you don't need the full amount. But again, the price can change, and it's not just based on the net asset value. By the way, this is called the NAV value, but again, that is another video for another day. However, here is a simple example here. Again, we're going to use a basket and the egg example. The eggs are the companies, and the basket is the actual ETF that actually owns all of those eggs that are actually in there, okay? Now, the idea is there is an ETF that you probably know, and that's called the Vanguard SP 500. Now, that holds, for example, the largest 500 companies in the US. Tell me, why 500 companies? Because in reality, those 500 companies are responsible for over 80% of the growth of the entire US stock market. That's why 500 is enough. The rest, and there are over 1,000 or 2,000 like actually stocks in the market actually being traded publicly. The answer is, well, that top 500, like the Apples, the Amazon, the Teslas, those and the Walmarts, are responsible for basically around 80% of all the growth that happens in the stock market. It's part of the 80-20 rule. If you guys know about that, then you guys know about that, right? But overall, let's say, for example, again, I have this basket, I have this ETF, and in this ETF, we basically have around 500 individual companies, okay? 500 eggs. Now, whenever one egg breaks, well, in reality, there's a company right there waiting to actually be moved up into the S&P 500, and that is a big deal, because basically, they do get a lot of extra money and a lot of extra funding. So, for example, if you have Apple in the S&P 500, right? And basically now Apple is worth $0. Well, it gets moved down, another company comes in and replaces it. However, let's say, for example, I have this basket, I have 500 eggs, 500 companies, and let's say, you know what? Each egg is only worth $1. In total, that means I have, for example, $500 of net value assets. Now, if that company goes ahead and issues, for example, just 50 shares out there, what exactly does that mean? Well, I know for a fact the value is $500, and I issue that, for example, 50 shares divided by 50, that's around $10 per share. And that's how you basically get the net asset value of that ETF. But again, because the stock market does not work just based on value, and it is traded, for example, in the stock exchange, it can be influenced by supply and demand. So now, for example, Bob heard that I'm making money from the ETF. Now he wants to go ahead and buy. Now he tells Miranda, Miranda tells Johnny, Johnny tells Paul, Paul tells Peter, and then before you know it, there is a big rage about this ETF. And before you know it, it can be pushed way beyond of what the actual assets within that ETF are actually worth. And by that point, it's not actually worth buying. But there is a way to kind of like say, hey, but how do I know the real value of it? In reality, it's right there on the website. I'll show you later on. It's like the NAV value, the NAV value, the net asset value on the website, on the Vanguard website. But overall, the answer is there is a way to buy an ETF to make sure whether you buy high or low, you're still going to be well off. And I'm going to tell you guys about that later on in the video. But overall, without the egg and the basket example, an ETF is usually just tracking some form of index, okay? That's the whole idea. So if you want to track the largest 500 companies in the US, you have that right there. You actually own all that stuff in that ETF. And that's basically it, okay? That is what you're buying. You're buying the basket that holds all the companies, and that way you're really diversified. But because, again, you have different baskets. You have technology basket, you have the US basket, the small cap basket, the real estate basket, the international basket. You also have bonds, corporate and treasury bonds, okay? You want to have a piece of all those baskets. That way you have the highest odds of being diversified and also not carrying that much risk. That is the overall idea here, okay? Now, by the way, any moment you're confused here, comment down below. I'll be in the comments responding to comments. That way you know what's up, okay? Now, by the way, when you invest this way into ETFs, is usually for passive investors, meaning you don't want to go out there and risk your money buying individual companies. You don't want to go out there and spend hours and hours researching companies just like Warren Buffett. The answer is all you want to do is invest your money, make more money in the future, and that's basically it. It's passive, passive, passive. Is not active, active, active. Active is I go out there, I research a company, balance sheet, cash flow statement, income statement, 10K forms, 10Q forms. I do all the research, the management, the company, the employees, the products, the sales, all that stuff. And then I go ahead and say, hey, what's the intrinsic value? And then I go ahead and I buy it based on, is it selling at a fair price? No, that's active. It takes hours and hours and hours of work. But passive is more like, hey, I buy this ETF, I get the market return, which is around 7 to 8% annually, and I become wealthy over time without having to do all the work. And I'm also very well diversified, so that way I also don't carry that much risk. And in reality, that is what most people are supposed to do, but a lot of people like to gamble, but I'm not into gambling, and that's why you're probably here also, okay? Maybe 10% for that stuff, yeah, but the bulk of your money should be put towards passive, correct investment methods, okay? Now, number 2 here. Tommy, all right, so I know what an ETF is, the whole egg and basket story. I get it now, okay? Everything is perfect. It's cemented in your head forever, hopefully. Now, Tommy, where do I go out there and buy an ETF, okay? Which ETFs do I buy and where do I buy it from? Because as you know, Tommy, there is Schwab's, there is Fidelity, there is Vanguard, there is SoFi, there is Robinhood, there is a lot of apps out there. That's the whole point, okay? So what app do I use to actually go ahead and buy these ETFs? The answer is, they're just brokers, okay? So a broker is just kind of like the third party to actually get you what you want. So it doesn't really matter where you go, but what I look for is basically simplicity, consistency, and also very, very low fees. So I don't want to pay to buy an investment. That's the whole idea there. And on top of that, I want simplicity. So I don't want to keep doing all the work all the time. So the app I use is called M1 Finance. I've been using it for a long time now. Now, if you guys want to know exactly what I invest into, well, watch this video. But on top of that, if you want to invest into exactly what I invest into, the answer is I have a link down below to M1 Finance. And when you sign up, you also get between $10 to $30. And you can also click, hey, invest directly into what Tommy invests. That way, you have my portfolio and you don't need to do all the work of setting everything up. And again, M1 Finance is free. It's simple, and on top of that, it allows you to have a very good basket balance. Meaning, for example, if I want to have my portfolio be, for example, 30% in the US market, I can do that. 10% into the international market, I can do that. 50% to something else, I can do that. But every time I invest money, the money is going to be spread so I maintain that entire balance. That's the whole idea, and that's why I use M1 Finance, and that's why I like the M1 Finance app so well. It's called dynamic rebalancing. That way, you never have to do any work. That's what I love about this investment app. Now, let's get into it, guys, okay? And by the way, if you see my portfolio and you say, hey, Tommy, I want to take on more risk or I want to take on less risk, the answer is I also have a video down below to different portfolios that you might want to invest into. So just go ahead and basically click that video once you're done here and say, hey, I want to do this one or that one or this one. And this, we can go ahead and set it up if you actually want to. Now, let's go into my phone. This way you know exactly what I'm actually investing into. Now, again, I always do this to make sure you guys know for a fact that this is actually me, it's actually my phone, okay? So right here, I'm gonna bring it up right here, okay? It's my phone, the calculator app, okay? So if I click around here, it's the same exact thing. Delete, oh, why do you click delete? Delete here, boom, 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 and it's me, okay? It's my actual phone. Now, I'm going to go over to the M1 Finance app, okay? The app I use, again, link down below, invest exactly what I invest into. Now, in this app, I have around $153,000. Before this app, I used Acorns. I didn't like it because basically they have too much control. I also use SoFi, but they don't have the dynamic rebalancing, so that's why I left there, and that's why I'm over here. But I am transferring my assets from SoFi over to M1 Finance, and it should arrive very soon, and that's how I'm gonna get like around 180 to 190K invested here. Now, the idea is, again, by the way, you only need around $10 to invest, so you don't need a lot of money whatsoever, so don't worry about that. Now, right here, guys, okay, I invest into a moderately aggressive portfolio. A portfolio is just a collection of investments. So if I have, for example, 10 investments, well, that's my portfolio. If I have one investment, well, that's my portfolio. Just have one, okay? That's the whole idea there. So let's click right here, my portfolio. And I invest into 7 different ETFs, okay? 7 different baskets. And every basket gets more money or less money out of my pocket because basically I want to maintain a very good balance. Now, 5 of these ETFs are issued by Vanguard, a very trusted company for a very long time. And also 2 of them are issued out by BlackRock, also a very trusted company out there. Now, by the way, if you have Fidelity or Schwab's, they'll probably have their own ETF versions of these. So if you want to invest with them, that's fine also, but I like simplicity here on M1 Finance. Now, the first ETF I invest into is called the Vanguard SP 500. Remember the example about the largest 500 companies and the 500 eggs? Well, this is that one. And I invest 38% of all my money into this ETF right here. Why? Because this right here contains the 500 largest companies in the US, meaning I want to be invested in the US because, as you guys know, the US is basically the best market currently right now. So most of my money goes into the US, okay? Into the Amazons, into the Googles, into the Teslas now, into Walmarts, you know, like the big companies. And that's why I have this. On average, this might make between like 8 to 10%, okay? That's the whole idea. 38% is how much money I put in here. By the way, you can adjust it as you like, but I highly recommend you follow this through. It was made by someone that is 10 times smarter than me and you put together, okay? Now, second, I also have, for example, the VEA, the Vanguard Developed Market Fund, okay? Now, this right here is very important, and I only put around 16% of my money in here. Tommy, why invest into developed markets, okay? The answer is, well, this is developed markets outside of the US, so big companies outside the US. Tommy, why? Because basically, as you guys know, although America is basically great, right now we're great, right? But some years, the international market, you know, like China, the Europeans, all that stuff, they might go ahead and outperform us. So I also want a piece of that pie, okay? So the US market is basically making me 21% right now currently, but the outside market actually made me around 29% currently. And that's why sometimes we're going to outperform them, but sometimes they are going to outperform us. And that's why we want that healthy mix. So 38% US market and then 60% into the entire international market. And then we have, for example, small cap ETF. And I put around 14% of my money into the small cap ETF. Tommy, why small cap ETF and what is this? Well, small cap companies are smaller companies, not like the Googles and the Amazon. No, they're smaller companies being traded. Now, this means, for example, very high potential for growth, but it also means very high potential for failure, okay? And that's why it's only 14%. So on some years, I'm going to make a lot of money here. On some years, I'm not. And it just happens to be that right now this year, I'm up around 54%, but again, on some years, I might not be that high, okay? It's very high reward, but it's also very high risk, and that's why it's only around 14% of my portfolio. On top of that, I also hold bonds. Bonds, as you guys probably know, is basically you buying a company's debt and they agree to pay you a certain amount of interest rate until it basically matures in maybe 1 year, 3 years, 5 years, however they actually lay it out, okay? That's the whole idea. Now, I hold debt basically in corporate companies, so like the Amazons, the Apples, all that stuff, and I also hold debt in the treasury, so basically the government's debt. They issue out bonds all the time. Now, the idea is this right here is not to make you a lot of money. It's just to have a more balanced portfolio. So when the market crashes, usually bonds are going to outperform stocks. When stocks are down, bonds go up. When bonds are basically down, stocks are going to go up, okay? That's the whole idea. It's kind of like a seesaw. So when you go up, this goes down. When this goes up, this goes down. So this way, you have a more balanced portfolio and you're not taking that much risk. Now, I invest 10% into treasury bonds and also invest 10% into corporate bonds. Right here, they are, and that's SHY and also LQD. LQD are the corporate bonds, like the very high graded ones, meaning not that much risk, they will pay. And also, SHY are basically the treasury bonds, the government. If they don't pay, well, everything is ruined. And at that point, it doesn't really matter, okay? And by the way, you also have like junk bonds. Don't get into that, okay? You don't want to basically buy somebody's debt when they don't have any chance of actually paying you back. So you want to basically buy this is high grade bonds basically for companies that have a very, very good chance, like a very good credit score, and they're going to basically pay you back, okay? Now, I also have investments in VNQ as basically the Vanguard real estate ETF, meaning, okay, although the stock market is great, bonds are great, I also want to have some money into real estate, into a REIT, you know, a real estate, what is it called? A real estate investment trust, okay? The idea is I want to make sure maybe sometimes the market is actually down, bonds are basically just staying the same. Well, the real estate market might not actually be affected, and that's why I also want to have money in there. But it's only around 8%. And by the way, these investments right here actually pay you a lot of dividends. So as I get older and older and older, and I win the game of investing, I'll probably invest a lot more. That way, I can get back a lot more dividends and live off that dividends. Now, lastly, I also invest 4% of my money into the Vanguard emerging markets, okay? That's also an ETF. All these are ETFs, okay? But overall, this right here is very risky. Okay, very, very risky. Some years you'll do great, some years you'll do terrible because basically it is very high risk, and that's why I only hold around 4%. It's basically into emerging markets just coming up now, meaning you might make a lot of money, but you might not make any money. Right now, I'm up 36%, but the answer is, guys, okay, I want to say this and I want to make this very clear. Just because your investments are up 1 year does not mean you change the plan. If you're going to invest this way, you're investing like I am. So basically for the long run, for the long term, meaning 10, 20, 30 years. So some years you'll do great, some years you won't, but the answer is you want to stick to the plan. Don't say, well, the US market is doing great, let me put in a lot more money towards that one. The answer is no. Stick to the plan, stick to the balance, and that way you will be better off. And again, that's basically the ETFs I invest into. So I have in the US market, in the small market, into the international market, emerging market, into corporate bonds, into treasury bonds, into real estate, into basic markets just coming up? The answer is this right here creates a perfect balanced basket. Does that make sense, guys? This way, if the US goes down, doesn't matter, I'm good over here. If the market goes down, basically doesn't matter, I have bonds. If that goes down, well, I still have real estate, okay? That's the whole idea. You want to have balance across every field, okay? It's called diversification for a reason. Now, guys, that's basically how I invest my money, okay? So when I put in $1, that dollar gets split up in all those ways. This way is diversified. However, Tommy, how much do I invest and how do I invest? Again, we're going to invest with the M1 Finance app. Link down below. You get $30. But on top of that, okay, here is what I recommend. Once you are debt-free, and you also have, for example, an emergency account, at least 3 to 6 months, then you want to go ahead and invest. If you don't know how to do that stuff, the video on basically getting rid of debt and also have an emergency fund account, I'm also going to link it down below. But the answer is, okay, once you have all those things taken care of, I recommend you invest between 20 to 25% of your money into this portfolio right here. This way, over time, you keep growing and growing and growing your money. And when you retire with a lot of money. But tell me, do I invest every week, every year, every month, every day? How do I do it? The answer is I recommend you do something called dollar cost average, which basically means you're going to buy every week the same amount of money, or for example, every month. Now, the way I do it is basically, if I was making $1,000 a week, okay, I would invest 20% of that money every single week in my portfolio automatically. That way, I'm buying both high. Right now, the market is high, but when the market crashes, I'm also going to buy low. This way, I get the average, and that is what dollar cost average basically is. Okay, so as the market is high, invest the same amount of money on the same day. That's the whole idea. So every Friday, I invest money. Okay, the same amount of money. Over the year, I'll buy both high and low, and I will get the average. That is what you want. And over a long period of time, that's best. So if you have, for example, let's say you have $10,000. By the way, this right here is prop money. But if say, for example, you have $10,000, you don't want to grab this money and invest it all at once. The answer is no. You divide it by 52 or by 10 and invest that money over that period of time. Because basically, if you invest 10K today, and the market crashes, now you have to wait years for it to recover fully. That's why I don't do it that way, okay? That's the whole idea. And guys, that is it for this video. Hopefully, I broke down all the basics, and hopefully, you're becoming a better investor by watching this video, okay? Now, if you like this video here, guys, well, like this video. On top of that, if you're new here, subscribe and hit the bell so you get notified. And if you guys want to text me or talk to me one-on-one, join my Patreon, link down below, or send me a DM on Instagram at TommyBryson. And before I go, if you want to watch a full video, okay, on those portfolios and different ones, in case you want a different one, the answer is here's the video right here, and click my face right now. I'll see you guys tomorrow. Thanks for watching, and as always, peace.